Hello, everyone. Welcome to our video series. Allow me to introduce myself. My name is Droll Eskelund, and I'm a real estate agent with JLA Realty here in the Houston and surrounding areas. On the call with me today, I have my partners, loan originator Jennifer Rader with AmCap, sales executive Cathy Deaton with First American Title, and agency owner James Acosta with Farmers Insurance. So today you will get a well-rounded amount of valuable information. So let's get to it. How's everyone doing today?
Doing well. Rachel, thanks for having us.
Awesome, awesome. So I wanted to start off with the why we're doing this video series. I think there's a lot of questions out there that buyers and or sellers want answers to in regards to, the housing market or how the process actually works when, they're trying to buy or sell and what all is needed. So we really hope to get all those questions answered and help you gain the knowledge that you need when going through this process. I was telling Jennifer the other day that when I first bought my first house, I went into it completely blindly, not knowing anything about mortgage, loans, interest rates, home insurance, title, none of that. And it would have been really nice to have the power of knowledge to make those informed decisions during that process. That's really one of the reasons I became a realtor too. But let's get into what's going on in the housing market right now. The biggest misconception I hear about buying right now is that it's smart to wait for interest rates to come down, and you don't need to wait. What you do need is if you know that you're ready to buy, is you need an agent who knows the market in your desired location and a trusted lender who can help you understand what you can afford. The truth is, if you buy at today's rates, you can always refinance later when the rates drop. But if you wait with the hopes of it coming down, you can't go back to today's rates and, use the rate that we have today. So it's not how it works. The next time you think, maybe I'll wait, don't do it. Listen in on today's call so you can make a decision based on facts. And with that being said, I'm going to hand it off to Mr. James Acosta here so he can discuss some of the insurance rates. James?
Yeah, of course. Thank you, Rachel. Thank you for the introduction. And I agree with everything that you've said. First of all, as Rachel mentioned, my name is James Acosta. I'm a Farmers Insurance agency owner here in Houston. We have a team of 20 of the smartest and kindest people that work in our agency that you would ever want to work with. We are built for realtors and lenders and everything associated with real estate. That's 90% of the business that we write is done through a real estate transaction. We brand ourselves as a farmers agency, but as Rachel knows, we write through multiple companies. So we're writing through 20 different companies with the goal of finding Rachel's buyers and clients the best coverage that is able to offer in the market at the best price point. And so let's talk about coverage and price for a moment. I think those are two things that are at the forefront of when we're talking to Rachel and her buyers and Cathy and Jennifer's clients is coverage. We want to make sure that, things like the freeze that happened in February of last year, that there's coverage for that. We want to make sure that obviously we live in a coastal area, greater Houston area. So we want to make sure that weather is accounted for, whether it's, associated with the roof or trees or anything else. And I think that's something that we talk to our clients a lot about is we may see a rate from a company, maybe it's a competitor that may be $100 or even $200 less than the rate we're offering. But as we unpack that rate, we discover that things like water coverage is limited to a certain dollar amount, or there is no what we call backup of sewer and drain, where the plumbing starts flowing opposite directions. And so as we unpack that with buyers, they begin to realize, hey, it's not just important, what am I paying for this policy, but it's also important, what am I getting in the product? And that's what we do within our agency. And it's why Rachel and our other business partners trust us, is because we get our product into market through advice, through consultation, like everybody else on this call does. Price is a consideration and it's important. One of the things that will be important in your buying process is what we call debt to income ratio. And that is to say that we want to make sure that, that the amount of insurance doesn't exceed what AmCap or the lending organization requires of the buyer. And so we have we have cost options to serve everyone, and cost. I will tell y'all right now, if you're a homeowner, or if you drive a car and have auto insurance right now, which I'm sure most of y'all do, because it's Texas, we don't walk anywhere, right? We
Yep.
drive everywhere, and I love that about our state. But rates are going up. And the reason rates are going up is in large part due to what's called loss ratios. That's insurance talk for every insurance company on the planet is spending more money in claims than what they're taking in premium. And that simply means that if an insurance company takes $1 in, they're spending $1.25 in claims. And there's 3 contributing factors for that right now. Number one is the cost of material, whether it's a bumper or whether it's a roof, is more expensive. The cost of labor to put that on is more expensive. Litigation is a factor. We're seeing more claims go to litigation than ever before. And then lastly, I will say that there have been carriers, insurance companies that have left the market. There have been 5 companies this year, insurance companies, that have exited Texas just because of the coastal exposure. Please don't be alarmed by that. We still have plenty of options for our clients. But it is more important today than ever that that a consumer be talking to someone like us who can offer choices, who does things consultatively, like Rachel and everybody else on this call, and not transactional, where they just give you a number and hope and pray that you buy that product. You need to know what those coverages are, and you need to know what it is you're spending your money on. And thanks to Rachel, we get introduced to you guys, and we can help you in those areas.
So I agree, James, absolutely. It's all about relationships, not just transactional. So the more information we can get, the better.
Well, that being said, I want to introduce you all to an incredibly smart, kind, talented person named Cathy Deaton, and I will let her take it from here.
Thank you, James. All the kind words. And also to what Rachel said, relationships are so important in this industry. You want somebody that you can lean on and you can turn to. If I have questions, I can turn to Jennifer. Now that we've partnered with James, I can turn to James. So it is very important that you have those relationships. And I love that you're doing this, because there are questions that get asked. I remember when I got into title, they said, do you know what title is? I'm like, yeah, it's like your car insurance and title, car title, right? And they're like, no, it's absolutely nothing like that. So what I'm going to kind of address today is, what is title insurance? Title insurance is a way to basically protect yourself from legal expenses or any financial loss. And if, like, for instance, if there's an event that there's a defect in the title towards your property, that will be covered by the policy that's issued. It is different, again, from title insurances like car and like James was offering. Our examiners, actually, when we get the contract in, our examiners, they go to work and they start trying to figure out the history of the property to make sure that they can eliminate any title issues that pertain to that property. Do we need it? Yes, we need it, because it will protect you from one of the largest investments that most people make. So it is an absolute must. You will have clients that go, well, do I really need title insurance? Just say yes. Yes, you do need it. How much does it cost is another question. Typically, it's a one-time premium, and that's paid at the purchase of your home. That price that includes the coverage that pertains to that property indefinitely until you sell to the next one. Another thing that I like to go over to, sorry, I have my little handy notes, is what owner's title policy is. And that protects you from title defects that might have existed before the issue date of the policy. So in the event that something might happen and a claim is filed, the owner's title policy will cover the financial loss up to the face value of the property. Is that something that we need? Absolutely, yes. That's what you tell them. There are some examples of problems that might arise, for instance, like fraud and forgeries, unpaid taxes or judgments, documents that were executed wrong. Those are some examples that could maybe halt it. Unreleased mortgages, I'm sure Jen will probably follow up on that. But all of those basically are so important. That's the sum of the whole coverage. So when you have clients that ask, is it important that I have title insurance? It absolutely is, because it's covering them and it's protecting them. So again, this is stuff that I'm basically reaching off of. I'm not smart like the escrow team. I'll be very honest with you.
Turn left.
Oh, where are we going? Somebody's going somewhere. Yeah, so I'm the marketing rep for First American Title. I have the privilege to market for them. We're all over the Houston area. If Rachel, if you and your clients have questions, I would love to help you guys. And I guess I'm gonna pass it on to you, and you can direct where to go from there, right?
Thank you, Cathy.
You're very welcome.
Jennifer.
Hello. So once again, I am Jennifer Rader with AmCap Home Loans, and I partner with these beautiful people. So excited to be doing this video series. There's so much we can talk about, not just today, but every day that we do this. So we're really excited to bring valuable content to you guys as general users, because the general public doesn't really know, like Rachel said, even when I bought my first home, I wasn't in the mortgage industry then, but I didn't know anything. I really didn't know anything. And to come full circle and to be in the industry now, I want to pass that knowledge on, which is kind of the reason we're all doing this for you. So my portion of today is going to talk about mortgage rates first and foremost, because that's what everybody's talking about. That's what everybody's scared of. That's what everybody's worried about. I can't go anywhere and say I'm in the mortgage industry and have someone not say, well, what's the rate today? It just doesn't happen. So it's really important for us to kind of learn to understand where we are today, to kind of understand where we've been for the last couple of years. And it might get a little, complicated to explain it to you, but I want to explain it to you the most simple way that I possibly can. So everybody thinks the Fed sets the rate for mortgages. They do not set the rate for mortgages. The Fed actually sets rates for short-term loans in the borrowing between banks when they hold they lend money overnight. So the Fed sets that rate. Now, mortgage rates follow that trend, either sometimes opposite or the same, depending on what's going on in the economy. But our rates are actually based on the 10-year Treasury, which is also based on the government. So, and I also have my notes, so I'll make sure I don't miss anything here. So the effective rate, so the Fed moves the rate up and down depending on what's happening in the economy for different reasons. Changes in the effect of rate in times of crisis like COVID, right? Let me kind of give you an idea. So before COVID started in February of 2020, the Fed rate was, I think it was 1.58. That was their percent rate. During COVID, within 2 or 3 months, it was down to 0.3. Then it went down to 0.05, so basically zero, right? So they went from a normal rate to a zero rate, because what were they trying to do? They're trying to help the economy because of what was happening to us, right? People were losing their jobs, people couldn't spend money, people were having issues all over the place. So their response was to lower that rate to help the economy, right? And it did. I mean, it really did. How many people refinanced? How many people were able to purchase because rates became so low? So make sure I don't miss you here. Yes, so they lowered that rate. In addition to lowering the Fed rate and helping the economy in that way, they also decided to buy billions of dollars of mortgage-backed securities. Now, the government always buys mortgage-backed securities, and they have for, I don't even know, 60 years or something, some long amount of time. They've always bought mortgage-backed securities, but always at a different rate. Well, during COVID, they said, not only are we going to lower the Fed rate to help the economy, we're also going to buy billions and billions of dollars in mortgage-backed securities. So all of a sudden, we had these huge purchases of all these bonds, all these securities during COVID, and that also drove the rates down, okay? The combination of both of those made our rates, the lowest rate I think I had during that time that I gave to a client was in the ones.
Crazy.
Wow.
I still can't believe it.
No.
How did it get there, right? But kind of normal for 2020 and 21 was in the 2s and 3s. That was pretty average for that time, which is still ridiculously low and is actually not healthy for the economy. We cannot sustain that. So in 2020, the government, or sorry, 21, or actually no, the end of 2020, the government let us know that they were going to start tapering of those purchases, which we expected, right? They had to react heavily, and the world reacted heavily as well. Most countries did that with their own rates. But because we had to react so quickly, we had to somehow get ourselves out of that. So the government told us they would start tapering out of buying those mortgage-backed securities. Well, tapering means a slow recovery or a slow process, right? So at the end of 2020, we kind of expected things to start slowing down or those purchases to start slowing down and rates starting to normalize. Well, in 21, they decided just to keep the purchasing going. So we had a little bit higher rates in 21 than we did in 20, but we still had ridiculously low, historically low rates because they were still buying all those securities and they were keeping the Fed rate low. So now comes, say, third quarter of 21. Government again says we're going to start tapering. Okay, so we expect it this time. It's now been 2 years that we have rates that shouldn't be as low as they are, and we know that they're going to start tapering. So, and I've forgotten my little chart here. I left it in the other room here. But what they did in March of 22, the Fed rate was, I think it was, and forgive me if I have the number wrong, but it was like 0.05. So it was still very close to zero. Mm-hmm. By April, May, they had brought it to like 0.77. We are now at 3.7. So not only oh my gosh, yeah, not only did they change everything, they tapered, they didn't taper. They all of a sudden said, nope, we're changing it and it's tomorrow. I mean, it really happened that quickly. Over a 6-month period, we went from a zero Fed rate, and I think we're in the 2s or 2.5s at that point. Well, what does that do to the economy? It's crazy what it did to the mortgage industry, and it's crazy what it's doing to the rates currently. Yeah. So I think the only fault, or the biggest fault in my opinion, is that they just did it so fast. They did it too fast. We were ready for it, but we were ready for it on a gradual scale, and it came super quick. So the industry wasn't ready for it. The government, other parts of the government weren't ready for it. And buyers are now like, what is going on? We have no idea. And people who've not been in the industry long think, oh, we're going to get 2s and 3s. That's what it's been for the last couple of years. Well, now we're in the 7s. That's huge, in just any kind of adjustment period. That is huge. We haven't been in those rates and I can't even tell you how many years. So the bottom line is they did what they did to help the economy. Now we have inflation problems, and the way to fix inflation, part of the way to fix inflation is to raise the Fed rate. Well, when the Fed rate raises and they stop buying all these mortgage-backed securities, now rates are coming back up, which is what we wanted to happen. Honestly, we wanted that to happen because that's a normal economy. We just didn't expect it so quickly, and we didn't expect it to go so high. So what does that mean? What does that mean for today? What does that mean for tomorrow? What does that mean for your buyers that are in there, thinking, should I buy now? Yes, you should buy now. Just because rates are high right now does not mean you shouldn't buy, because what's going to happen, especially in Texas and especially in the Houston area that we're isolated from a lot of the other issues that other states are having, which we're so blessed for. But because of that, we don't have to really worry about any of that stuff, at least not to the degree that other people do. So yes, buy now, go ahead and pay the higher rate. And when rates normalize, which we think is going to happen 18 to 24 months or so, we can refinance, right? So if you find that perfect house or the perfect area for your kids to go to school, or whatever your reason is for moving, do it. Take the higher rate for now, make sure you can afford that rate, and then let's just do a refi. Let's review it again every single year, see what rates are going to do, and we can always refinance that and get you into a more comfortable payment. What a normal market is, typically anywhere between 4.5% and 6% is what we consider normal in our area. That's what will sustain the economy. That's what will help us to keep going and not have these drastic highs and lows. So overall advice is definitely to buy now. Call us and let's talk about your situation and make sure that's the right decision. It may be that someone shouldn't buy now for some other reasons, or maybe it is that, right? But in general, buying now is what you should do, because you're going to get the house that you want. Maybe the rate's a little high for what you really want to see, but we can always adjust that in the future.
Date the rate, marry the house.
Correct.
Yep.
We have a social media slogan going out for that all the time.
I'm sure y'all do.
That's the truth. The rate is temporary. And a lot of buyers, even, of course, first-time home buyers for sure, but even repeat buyers that haven't bought in 10 years or so, they kind of forget that the mortgage is not a permanent thing, right? Of course, it's permanent in the fact that you're borrowing money, but the rate for that is not permanent, because you can always refinance. You can always do a cash out refi and pull equity out. There's so many different options. So the house is permanent, but the mortgage is not.
Yep. I think it's what a lot of first-time home buyers don't know and don't understand. So it's good that we're bringing that to light.
Yeah, they think a 30-year term, oh my God, I'm going to be in this in a particular loan for 30 years. Well,
Yep.
not really.
Awesome. Well, thank you, Jennifer. I really appreciate Cathy, James, Jennifer, all the information that you brought to us today. To all of our viewers, thank you for tuning in, and please stay tuned for next week. We have a lot more information coming your way, valuable, detailed information about the real estate industry, and we look forward to seeing you then. Thank you.
Thank
Thank
you.
y'all.
Bye.
Bye.